Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another podcast. Today on Hustle and Grit, we have Andrei Tasevski. Andrei is an experienced financial advisor with a decade-long history working in the financial services industry. Skilled in asset management, retirement planning, investment advisory, mortgages, and estate planning, Andrei is a strong finance professional focused in financial planning. Welcome to the podcast, Andrei.
Thank you for having me.
You know, I'm going through your profile, and you've got like a rich history, not only a rich history, but you've got like a wealth of, I guess, areas that you have kind of expertise in. Why don't we just kind of jump right in, and if you could give our listeners a little bit of an understanding of how you got into what you got into and what exactly it is that you're kind of in as well, because most of the time I have a lot of mortgage guys on, I've got a lot of real estate guys on, and I feel like you're adding to that with financial planning, whether it's mutual funds or any other kind of investments. So how did you kind of get into all of that? If you could just give us a good understanding of that, as well as like how'd you get into what you're doing, and what are all the things that you're into?
Oh, for sure. So after high school, obviously I went to a post-secondary. I took finance as my major. My older brother is also in the same field. He's in the industry as well. And it kind of runs in the family that we are part of finance. Upon graduating, I decided to go into the financial planning world, as I thought that this is the place to be for me. After graduating, I started working with Investors Group, which has been seen by myself at the time as the best place to start. It is one of the biggest mutual fund companies in Canada, still to this date. They're very well known for providing amazing training to newbies like me, straight out of school, which I think at the time it added quite a bit of value to what I am today. And then obviously I'm duly licensed in mutual funds and life insurance since 2009. And after working for a couple of years with Investors Group, I switched to a different brokerage, and eventually I ended up with Car Wealth Management, which is my current investment dealer for the last 7 or 8 years. As my business was growing, I was giving out referrals my existing clients to other mortgage brokers, and I thought to myself to keep on building my brand. I thought it's important for me to be able also be duly licensed. So I then went and I grabbed my mortgage agent license. The business started growing organically. I was not really pushing to become a mortgage broker. After 2 years, which is the minimum, you have to be a mortgage agent for 2 years, and then if you want, you can take another course to become a mortgage broker, which is something that I'm today. Again, like I said before, the actual mortgage business as the real estate business as a whole grew. My practice also grew with that one, and here we are today.
Yeah, I mean, typically I find like you do have people who kind of either are on the financial like investment or advising side or the mortgaging side, and I feel like personally they're very interconnected because for most Canadians, your house is where most of your assets are. It's your biggest investment, and to divorce that and the type of mortgages you take and from all the investments that you have, it doesn't, I guess, optimize your portfolio to the best you possibly can. For those listeners who don't understand when I say optimize portfolio, it's more like you want to get the most return or you want to build the most wealth over a lifetime. So is that what kind of got you into getting into both, or is it just kind of like, you know what, this is something that a lot of your clients were coming to you and saying, hey, do you have any mortgages? Can you give us advice? What kind of got you to kind of go from the financial side and then start you moving more towards into the mortgage area?
Awesome question. So again, where I try to be different to my competition on the financial planning side or the investment side is that I do provide actual written financial plans to my clients.
Mm-hmm.
And as you can imagine, and all of your listeners, to most of them, real estate is a big piece, as you just mentioned. So whether I like it or not, I, in a way, had to learn a lot more about mortgages because a lot of those monthly cash flow actually ends up being paid to whoever the lender may
Mm-hmm.
be. Most of it is with the Canadian big banks. And so for me to be able to provide better service and to set the clients to be in a better spot going forward 15, 20, 25 years from now, it was very, very important for me to learn that space. So that's what was one of the reasons why I got licensed and I started learning the business. At the beginning, I thought it's a very simple industry, but I learned along the way that it can be challenging because all of us have different circumstances and everybody brings a different issues to the table that we as financial planners or mortgage brokers have to solve.
Yeah.
And so again, part of that financial plan that I'm building for my clients obviously entails their investments in mutual funds or sec funds, but also, people love real estate where we live, as
Yeah.
you may probably agree with me,
Yeah.
and people look for options left and right as to how they can go, if they can, besides their primary residence, how they can keep on growing their real estate portfolio. And to that point, this was the main driver behind me deciding to get licensed as a mortgage agent first and then as a mortgage broker, because then I'm able to really provide to my clients what they're looking for without sending them to 10 different places where they will end up,
Mm.
number one, paying higher fees,
Yeah.
not maybe having the best solution, which then costing them money, which in turn then they can have less money to invest as a result.
Yeah.
So I think that me being duly licensed and knowing both sides, I think that I'm unique in that way. And that's why I think that I'm a bit different to most of my peers. And yeah, I think that that's the major difference between somebody like me who is duly licensed
Yeah.
versus somebody who just specializes in one field only.
Yeah, so I mean, I agree with you in that, like the siloed approach. Sometimes when you're looking at where you need to spend money, if you have somebody who kind of understands only one aspect of something and not another, I'm not saying they're going to give bad advice, but they may not be able to understand all of your needs, and it's not a holistic kind of perspective, which makes sense to kind of put everything together. And it's not like it's so far apart that you can't be an expert in both areas. They're both,
Oh,
again, just very, very interconnected. So
correct.
what's like if you could run through like if one of our listeners who's never had a financial advisor before, what's kind of the journey like to work with you? Do they just give you a call? Like, do you meet in person? Is it digital? What's kind of that entire process and you understanding a client's needs and understanding what they should, what's the best investment for them? So when I ask this, I mean specifically just on the financial planning side.
Fair question. So mostly people find me either through a way of referral, or now I'm also showing up on Google, so people get to research
Mm,
me and get in touch with me. The easiest way is for them to obviously contact my marketing assistant. Her name is Nadia, and then she sets up the meeting. She'll obviously check their schedule, check mine, and then usually since the pandemic, mostly my business went digital. So I'm big on Zoom as it does
Mm-hmm.
save clients' time and my time. So we're a lot more efficient with what we're trying to do. My process really is like to meet on that very first meeting for about 15 to 30 minutes. It's absolutely no obligation on either end. For me to be able to provide clients any sort of advice, I have to learn where they're coming from, what their goals are. And that's on that very first discovery call that I like to call. During that meeting, I try to learn as much as I can about that potential client, and then I do give a bit of a feedback uh, to them, and then obviously they can ask me any questions that they may want to ask me about anything about my past, my current clients, how am I running my business, my fees, my business structure, and so on and so forth. And from that point on, if we think that there is enough room for potentially working together, that's when we would schedule a follow-up meeting, which usually goes for about an hour, where we dive a lot more deeper than the very first discovery call.
Mm-hmm.
And from that second meeting, it's really where we decide if we can move together forward together, or they can go their own way, and then I continue doing what I continue doing on a daily
Yeah.
basis.
Yeah, no, I mean, you know what? Like, and the other thing is, what I like about this type of business model is I feel like, especially it's this case, it's the same case with mortgage brokering, and you're in the mortgage brokering side too. But I feel like the same thing on the financial planning as well. Whereas the reason when somebody comes to me and asks, "Hey, should I use a broker or should I go to the bank?" Though I love the banks and I always say that, I always kind of recommend the broker side just because the broker, if a broker is good at what they're doing, they're going to be there 10 years from now, right? At the
Oh, for
bank,
sure.
if a broker is good at what they're doing, they're going to get promoted. You're not going to see them again.
Yeah.
So when you're trying to build wealth, right, and you're trying to build wealth, even with mortgages, you want to buy your first house, you want to buy your investment property, you want to go and get a vacation home, your kids going to college, you want to refinance for that, or even build wealth for that. You don't want to be in places where, hey, the person that I'm was looking after me is kind of gone after whenever 5, 10 years. So my question then is, with mortgages at least, every 5 years or 3 years, whenever the term's over, you essentially are forced to kind of reevaluate that debt and understand, okay, what are the market interest rates? You're resetting, you're going back. With the financial planning side, is it more like a set it or forget it, or do you revisit what's happening? How often do you kind of revisit, if you do revisit your investments?
Very good point. To be honest, actually, on the financial planning slash investment side, it's more ongoing process versus mortgages, because mortgages usually most of them are set on a 5-year renewal
Mm-hmm.
schedule. So unless there is a change in somebody's life, whether they need to refinance to restructure the debt, pay off debts, or pull equity out to buy, like you mentioned, maybe a vacation property or an investment property, usually we can work with the clients every 5 years unless there is a big change in their lives.
Mm-hmm.
Investment side though, I at least myself, I meet with my clients mandatory for minimum of 2 times a year. One is the annual meeting that I like to call, which is in the month of January, and it's specifically designed for me to meet with them because of two things. Number one, we will review what we have done, both myself and the client, in the previous year, but also we are setting the stage for the year to come. When I say
Mm-hmm.
we are setting the stage for the year to come, remember the so-called RSP season usually goes up until March 1st, where people can make contributions for the previous year.
Mm-hmm.
By us meeting in the month of January, the clients still have, usually about 4 to 6 weeks to come up with any large sum of RSP contributions if they need to. So that will help us with also the tax planning part of my financial planning process. So then we will know how to use those RSP refunds, if there is any, towards funding going forward their future RSPs or maybe building that TFSA over the long term.
Oh, so
And
so you're reevaluating based on like the income and what they kind of generated over the past year. So you're looking
like,
at like, so that would kind of dictate the, for a lack of better terms, the new money that's kind of going into investments, right? But
yes,
in terms of the old money that's already investments, how often do you kind of look at that to see
that,
if you're going to move it, if you're going to keep it the same?
fair enough. Well, it's a bit of a loaded question because it all depends what's happening in the economy, right? The portfolios or the funds that work today, they most likely did not work in 2020, 2021. But at the
Hmm.
same time, what was making quite a bit of money in the pandemic year for those people who did not sell, who held on, and 2021, it was amazing years. People were making, I don't know, 15 to maybe 40%. Those portfolios, especially in the tech sector, now are getting hammered.
Hmm.
And I hear to that point, I have to be active with my clients' portfolios, meaning that we need to rebalance every time there is a major life change, or if the economy is on the upside or the downside, depending
Hmm.
where we are finding ourselves to be. So at this time, as everybody knows by now, interest rates are going up just to try to lower down the inflation, which is, lowering our purchase power, which is a huge issue. And this, in my opinion, is the major driver behind the number one, the market that's actually falling since the beginning of this year. But also, as everybody knows on this call, also the real estate market that most people did not
Yeah.
expect to has also tanked. Again, it's a reflection to, at the same time, how in 2020, 2021, the real estate and the stock market was on the upside pretty much more than anybody else expected at the time as well. So in a way, it's balancing out, but it's very important to know what is your end goal.
Yeah.
Uh, it's a long-term game for both real estate and investments. If you are investing just for the short term, then somebody like myself, at least, I'm not the person to talk to, as I'm really focusing on 5, 10, 15 years from now as to where we can be and how we can achieve this goal.
Yeah.
As far as real estate, again, everybody will tell you, you buy real estate and you hold it. It should You should be better off going forward by holding real estate versus maybe renting or just trying to flip every now and then. Because again, there's also fees that are involved in this one.
Yeah.
Your
Yeah.
land transfer tax, realtor fees, everything
Yeah.
plays into the big pile of money that actually goes out of the way that people don't necessarily think about when they're budgeting or planning what their profits may be.
Yeah, I mean, you know what, and this is interesting because I'm a big, I guess, a follower of like just investors like Warren Buffett and all of them, and when I look at what they talk about, and I try to bring actually those analogies into the real estate side because everybody nowadays is panicking. Oh my God, the house prices are going down, and they're like, we don't want to jump into the market. Whereas my perspective was last year, if anything, was when I was hesitating for anyone to jump in the market. When you had to go in with a firm offer and you had no conditions, you didn't see the house, no home inspection, nothing, and you went blindly above listing, hoping you got the house. Whereas now, when you can make a reasonable um, effort, right? You can go in, you can put in financing condition, you can find the house that you like. People are kind of backing off. They're like, "Oh my God!" And my thing is, this is not something that you're day trading. You're gonna spend the next 10, 15 years in the house, like you're just saying. It's a long-term play, and if it's a long-term play, Warren Buffett, for example, would be like, you know what? He said, if you guaranteed me a recession next year, I'd still be buying the same stocks that I'm buying today because they are going. He's more long-term, and then the next year, if there is a recession, he's just gonna buy more of it because the deal just got that much better, right? Because if you're investing on the right principles, it's all that matters. And what I feel for you in the financial side is, at least on the real estate side, when houses are the values are falling, people don't see the value of their specific house fall in terms of a real sense in like going somewhere and saying, hey, this is where your house is valued. They could say, okay, somebody else's house was sold and it went down, and so mine may have gone down. We don't know how much. But when it comes to stocks and if you're invested in that or mutual funds, you can actually see how much it goes down. And for the non-sophisticated investor, sometimes that makes them panic because they're like, "Oh my God, it's gone down," and they think it's going to be there forever and it's going to keep going down or whatever it is. Instead of saying, "Hey, listen, these ups and downs happen." And you're going to like it's going to come back up. So my I guess question to you is for those investors that are looking at stuff and they're pulling their hair out. What's your kind of advice on how, not necessarily what to invest, but what should your psychological state be when you approach your investments?
Excellent question. And this is something that I'm trying to educate my clients as much as I can, even
Yeah.
before they become clients of mine, so that our relationship will be better off going forward. So again, as I mentioned before, I'm not a day trader. I'm not licensed like that.
Yeah.
For me, it's more of a investing for the long term. If you look at the average rate of return, say on the S&P 500, I believe it returns 11.88% from the 50s to 2021, if I'm not mistaken.
Hmm.
So again, if you just bought then, left the money in, it would compound at over 11% year over year. And again, the average medium risk type of an investment is returning more or less about 7%. So that's beating the average of over 4% each and every year, right?
Hmm.
So again, when you're buying, let's say mutual funds, like you mentioned now, you can see your portfolio on a daily basis, which is totally different to real estate because we don't get to have this information, this data with us. And people tend to panic more as a result. And like you mentioned, the not so educated or sophisticated investors, they panic, which makes sense. But part of our job as financial advisors is to provide education, provide data, and really explain to them what the process is like. There's the market always goes up and down. Mostly those people who panic and sell, they then miss the best days when the market actually is rebounding,
Hmm.
and that has a major difference in somebody's rate of return over the last 1, 3, 5, 10 years.
Yeah.
So again, if you are not day trading, statistically, people are better off to be fully invested versus trying to time the market, because even like you're mentioning, Warren Buffett does say publicly that even himself, who has all the knowledge, and the team around him of super smart people with all this experience, even they cannot really time the market.
Yeah.
To that point, again, you should talk to your financial advisor. Go back to what your goals were. Look at the long-term game. Make sure that your risk corresponds with the portfolio that you have currently, and then again readjust to whatever the market conditions may be.
Yeah. No, and I think one of the biggest things is um, I, over the last 10, 15 years, everyone's become a trader. So it's like you see all these meme stocks, you see Tesla's going up and this and that when some of the most boring stocks is where your wealth is going to be created. And that's why like people like myself are not, and that's why I'm a big proponent of advisors, right? Forget about those apps or whatever it is. Like you need to go to somebody who can understand your risk profile, where you've invested, what you've bought, the assets that you have, all of that kind of push into a portfolio that you have to create over a long term. But everybody's kind of like, you know what? I want to get into GameStop before it goes. Like that's, I feel like before I kind of get into it, what's your advice to people who are kind of looking at stuff online and saying, okay, a lot of people are saying, oh my God, GameStop's going to go up. And that was for a bit. But all those meme stocks, Amazon, Fangs, whatever it is, you see a lot of it on the media saying, okay, go in here, go in there. What is your advice for people who are trying to build wealth or to plan financially over the next 10, 15 years? What is kind of general rules that they should kind of look at? Not necessarily, I understand you're not giving financial advice to any one particular individual, just general rules that you'd say, rule of thumbs that people should kind of consider.
Well, I'm not even able to give advice to anybody publicly because everybody
Yeah.
has different circumstances. But again, understand your risk to begin with. Uh, Understand that investing usually it's a long-term game, as I mentioned before. That's
Mm-hmm.
how it is for people. Yes, somebody will get lucky, make a bunch of money in those meme stocks that were especially popular in the last years. But if you look at their year to date, it's on the other side and nobody talks about it,
Yeah.
right? So again, as I we keep on going back to the long term, I really believe in that. As in everything in life, your career, it takes time to grow,
Yeah.
right? Your
100%.
relationship with your partner takes time to get to that next level.
Yeah.
Your real estate that you're holding, it takes time for that real estate asset to potentially grow. Some areas more, some less. We all get
Yeah.
that. Same as, again, the GTA was not growing as fast as the 905 area real estate in the last
Mm-hmm.
years, but at the same time, right now GTA is not falling down as much as the 905 area. So there is so many reasons why things are happening. And
Yeah.
same thing with investments. As I mentioned before, a winning portfolio for the last 2 years most probably is now the losing side or on the
Yeah.
downside. But again, another thing with investments, it's as you mentioned before, you can buy in different sectors of the economy, in different continents, in different countries. So it's on the mutual fund side or the sec fund side, you can diversify a bit more than with real estate, because with real estate, if you have a house or a condo in Toronto, you're stuck there, and whatever is happening in that area, you're fully affected by it.
Yeah.
Like the interest rate environment. So as the Bank of Canada is raising the interest rates, and by the way is expected to raise them again October 25th, 26th, by another
Mm-hmm.
50 points, that by default, all the borrowers, again, by default, regardless of the higher monthly payment, but people now qualify for less. So
Mm-hmm.
this is put pressure on real estate prices to go down. So that's the main driver. Not that there is not tons of buyers waiting on the sidelines, waiting to go in and buy.
Mm-hmm.
Is the qualifying criteria as to how much mortgage Canadians can afford is totally different to what it was prior to the rate increases that started back in beginning of March. Again, with investments, again, let's say if Canada is in such a situation where I'm just making this up, where the inflation is so high, but then if you can go and Japan is not, for example, then you can go and buy Japanese companies. As an example, I'm just making this up.
So do you help investors buy in foreign countries as well, or foreign stocks that are exposed to foreign economies?
We do, yes. So I don't buy individual stocks. We do buy funds, but those funds are, again, you have funds who invest specifically, let's say, in China or
Yeah.
the Asia Pacific or North America, or you have Europe. So we can choose more or less where we want to invest clients' money given to what's happening. So now, as we all know, the unfortunate war that's going on in Ukraine, it's affecting Europe as a continent
Yeah.
and their companies and profitability. So again, it's a bit more challenging to invest there versus maybe in Canada, which, because of the higher prices of oil and commodities, the TSX is doing a lot better, for example, than the European exchanges and the American exchanges as well. So
Oh
from an
wow.
investor point of view, yes, can the TSX has been faring better off versus its peers.
But would it be safe to say that TSX never got that kind of spotlight that its competitors did over the past 3 years? So maybe they were, I wouldn't say undervalued. I feel like maybe the TSX may be more pragmatically valued as opposed to our neighbors down the south, where everybody's just like, oh my God, your price to earnings ratios are like just through the roof.
Well, again, depending what the strategy may be, right?
Yeah,
Canada, we all know it's our economy in general is dependent to the U.S.
yeah,
The whole world is, but we are being the neighbors, right? We depend quite a bit on the U.S. And so, where we are winning currently is that our inflation went down from 7.6% down to 7%. It was
mm-hmm,
expected at 7.3. So the Bank of Canada raising the rates is actually playing a role. But even more so, the price of oil actually went down quite a bit in the last 2-3 months, which
yeah,
is helping inflation both in the US and Canada have the downside trajectory, which in turn does show us that Bank of Canada's aggressive increase in rates and tightening policy starts to to penetrate the economy. But it usually, they say, the economists are saying that it takes about 12 to 18 months for the Bank of Canada's policies to go through
Yeah.
the entire economy. So it will take time. It's not an overnight job, but Bank of Canada's idea is to have the inflation all the way down to 2 to 2.5%. We're far from that, as we are now at 7%. So it's gonna take some time. But the upside is that it's no longer on the upside, but it started to go on the downside.
Yeah.
So let's see what's gonna be shown by the Bank of Canada next month. But I do hope we're gonna have a further downside number as opposed to what it was in the last 2 or 3 months.
Well, it's going in the right direction, I guess, and it's going to take
Yes,
some time.
it
So
does
I
take
just
time.
want to wrap this up with a very loaded question because I love loaded questions.
Go ahead.
But for your average portfolio construction, and I'm not again, and I caveat this just because if I just want to hammer the home the fact that we're not giving any kind of financial advice to anybody in particular. If you have any questions, depending on where you're listening to this podcast, I'm going to have Andre's contact information on the either below or on the side, and you're more than welcome to reach out. But for the sake of this podcast, for a general nobody client, your average portfolio construction, has it kind of changed, or how has it changed from last year to now? Like, do you lean more towards equities or more towards mutual funds, more towards real estate? Like, how's it kind of changed from a year ago?
Very good question. Um, so again, where we see the most downside pressure, or downside stock prices, is mainly in companies that were exposed to borrowing, cheap borrowing, that
Mm-hmm.
needed to help their high growth. So most of them are tech companies, and when I say tech companies, I don't mean Google, or I don't
Mm-hmm.
mean Amazon, because they have too much cash sitting on anyway.
Yeah.
The smaller high growing company, like for example Zoom,
Yeah.
everybody all of a sudden in 2020 had to use Zoom, or first all of us were forced to use Zoom. But now, as again, we are kind of at the end of the tail of COVID, hopefully it's not going to come back. um, People are now meeting in person more and more. People are now even forced to go back to their offices, so the need to be forced to use applications like Zoom by default is going down, and the stock price is getting a big hit as a
Yeah.
result. So again, um, as I mentioned before a couple of times, the companies that were making quite a bit of money for their investors are now, most of them are not really in 2022. And to this point, I think that your listeners should be reviewing their portfolios with their advisors, as again, a lot of these portfolios, when I speak to my prospective clients, I always ask them, how often do you review your portfolio? When has the bank called you the last time? Unfortunately, I hear that mostly the banks, and not everybody, but again, mostly I hear from my clients who are coming from the banks, from the branch level. Most of them will tell me, I have not heard from my advisors in 2, 3, 4, 5 years,
Yeah.
which I think is horrible. Because again, everybody life is changing over the course of these 5 years in my example, and even more so the markets. So portfolios need to be
Yeah.
looked at least twice a year, in my opinion. This is what I'm trying to do with most of my clients, and I'm sticking to that one because I think is the right way to help clients achieve their end goal.
Yeah, no, I mean, especially during times like this where there's so much uncertainty. But like you said, like, yeah, I mean, as you're talking, I'm like, oh, like just a spark went off, and I'm obviously not in this industry, but the fact that like even if you as an investor stays exactly the same, the market's constantly changing, and where everything is trending is changing, and so you have to be investing with that trend, which is good because with that, for example, housing and real estate, you can't really do that, right? When you buy a house, you're there, but you have different ways of enjoying that house. But when it comes to your wealth and the investments, you can move it around if you're kind of speaking to your advisor, like you said.
Right. And through those funds that we have access to, for some of your listeners, you don't have to technically own a real estate piece to invest in real estate. There is funds who focus on buying real estate.
Hmm.
Could be residential, could be commercial, could be combined. So, every now and then I would have a client who loves real estate, but can no longer afford a mortgage to buy that next property, but still does have money to invest, believes in real estate. And we look at options of how he or she can invest in real estate through buying some mutual or SEC funds as part of their portfolio.
Yeah. No, 100%. 100%. Thank you for coming on the podcast. Again, if anybody wants to reach out to Andre, I'm going to have his contact information. Again, we're depending on where you're listening, either below or on the side. Andre, any last words?
Yes, just stick to your plan. It ends up working over the long term. I would try not to panic. If you don't have to sell, if you're invested in the current market, try not to sell or be smart with your moves. And to those investors who are really trying to time the market, I wish them best of luck. But again, statistically, it's a very hard thing to do.
I mean, it's next to, I mean, I would say impossible, but I guess, yeah. No, thank you. Awesome advice. Thanks for coming on.
Yeah, thank you for having me.